Hi, I'm Richard Hemming from Under the Radar Report. Great to be here. Today I'm going to take you through three stocks. I've been asked to do three stocks. The first one's I'm going to come out of the blocks pretty quickly with a big buy. This is a very exciting company, although you wouldn't think so from the 30% fall in the share price over the past few months. This company's in a hot sector in the food industry. It's an almond producer at Select Harvest. You might have heard about it. They've had a delay to the 2014 harvest. Now that's had reverberations in the stock, causing the share price fall. But what this company has is a very high almond price, and it's got it's got 10,000 acres, which is producing between 10 and 13,000 tons a year. What that translates to in dollars is around it's around $60 million a year at the operational earnings level. So this company is very cheap, trading on a 6 to 8 times PE multiple for next year's earning, and it's what you want, a company that's out of favour temporarily but has big earnings in front of it.
Hello, I'm Ken Bloomfield from Financial Clarity. My buy today is NAOS Emerging Companies Fund. This is a listed investment company. Listed investment companies are companies that buy shares and usually have a portfolio of listed shares that they accumulate. NAOS generally holds between 10 and 20 small companies in their portfolio. So they tend to buy companies less than $1 billion in capitalisation, and many of them are under 500 million. Why do we like NAOS? We like NAOS because they have been outperforming the market in their unlisted trust for a number of years, so we know that they've got a good pedigree as a manager, and yet they are trading at around about a 10% discount to what the shares that they buy and hold in their portfolio are actually worth. So if you add up all the shares that they hold in their portfolio, that's worth around about $1.15, and yet the shares are trading at about $1.05. So we think that as the company gets better known, they will move to trade in line with their net tangible asset backing, and as well as that, NAOS pays around about a 5% dividend. It's a good way for smaller investors to get exposure to a number of small companies and have someone smart doing the research for you, get some diversification.
Another stock I'd talk about to tell you about is MaxiTrans. This is a truck parts seller, and they produce and sell trailers. The trailers is the mainstay of the business historically, but this business is very cyclical. So at the moment, this company's been hit by the northern Queensland drought, and also last year by the federal election, the associated uncertainty. What you want with cyclical stocks is to sell them when things are doing really well, but to buy them when things are going really badly. So last year, this company produced around 26 million of net profit. This year, it's going to be more like 17 million. We think it's sort of moving down towards the buy kind of level, but it's not quite there yet. So it's one that we're going to be looking at, and also if they do some M&A, the stock get another parts business, which is far less cyclical than the trailer business. This stock will really outperform.
Our hold today is Telstra. Telstra has doubled in price over the last 3 years, which is quite exceptional for a company paying dividends over that period of somewhere between 5.5% and 8%, plus franking. Why do we think Telstra is still worth holding? We think Telstra is worth holding for the right person, for the people who want income in their portfolio. And of course, with a 5.6% dividend, which we think will be about 5.8% dividend next year, that's equivalent, if you take it pre-tax with the franking credits, to around about 8% earning from the bank or term deposit. So pretty attractive dividend. We think there might be a little bit of upside on the share price, but certainly it won't be doubling in the next 3 years. It's a mature business. We like two things with Telstra really. One is that the NBN payments are locked in and they are coming through and supporting cash flow in the next few years. And secondly, we think they're doing extremely well in the mobile phone area. Vodafone has kicked an own goal, to use soccer parlance, and they've had major network problems. That has helped Telstra to gain market share, and Optus has just kept market share. They're not trying to take it from Telstra because it costs them too much to do so. So Telstra, good dividend paying stock, maybe a little bit of capital growth next few years, but mostly for the dividend. It's a hold.
The next one I'm going to talk about is one that's a sell, and that's Lone Star. Lone Star has been a hot stock for under the radar. It's appreciated something like 70% since we first covered it only 4 months ago, and that appreciation, I wish it was all due to us and our foresight, but it's also due to the fervour with which this stock's regarded in the US market, where it actually operates. It's an oil and gas producer in the unconventional space, so it does fracking, and it's basically increased its barrels under production to 5,000 barrels a day, which is just massive. So last year it produced around 50 million operational earnings. Next year it's going to be something like 100 million. But what's caused its big price rise has been its exposure in the US market, where it's just recently listed. We think it's at 41 cents. It's got a lot of hype in the price, or there's been a lot of the upside factored in. So we're telling investors to take profits.
Our sell today is Coca-Cola. We were a supporter of Coca-Cola for many years at Financial Clarity. We held it in clients' portfolios right up until 2012. We started getting concerned in 2012 that there were some structural impediments to the industry. One of them is the fact that we thought Coke had gone to too large a premium in price to their competitors. The second was that we thought that there was a bit of a move away from sugar in drinks generally, particularly with mums buying soft drinks. So a couple of structural problems which have really come home to roost the last couple of years. Since early 2013, the share price has gone down from $15 to $9. A lot of brokers are now suggesting that you should be buying the stock at $9. We don't think so yet. They've got a new CEO, Alison Watkins, who's come into the fray, and one of the first things she said was that the company needed a major business review. That's a translation for downgrades and or potential write-downs. So we think that 2 profit warnings have come out in the last 18 months. We reckon there's another 1 or 2 to come, and or there'll just be a time to turn the ship around. So steer clear of Coca-Cola for now. Keep an eye on it though. It could be a good stock to buy sometime in the next 12 to 18 months.